Good evening, everyone. Welcome to Taxes in Retirement. I'd like to start by having you visualize this dollar bill as your entire retirement nest egg. It's everything you've saved and put away and gone without the past 40 years. It's your 401k, it's your IRAs, it's your pension plan, and it's your Social Security. It's everything you have, and it's the only thing you have to get you through the next 40 years of retirement. But there's a problem. This isn't all yours. This is fake, by the way. The IRS wants its piece, right? Inflation, which is going up, wants its piece. Healthcare, which is going up 3 times the rate of inflation and will be your largest expense in retirement, wants its piece. The kids move home, they want their piece. And the stock market plunges 30% like it did earlier this year. And this is your piece. This is what you have to get you through the next 30 years of retirement. Folks, we have a crisis. You're here tonight to learn how to put the pieces back together. My name is Mike Neben, and over the next 40 minutes, we're going to be taking you on a journey showing you some ideas on how to evade some of the taxes that a lot of folks face, and some strategies to stay away from some unnecessary taxes. So let's get started. A couple of housekeeping items. We are going to move pretty quickly throughout the workshop, and we will be fielding questions, but we aren't going to have enough time to answer all of the questions. So what we're going to offer, and I'm going to pop this up, this will pop up throughout the workshop. And if you would like to take 15 minutes to ask us questions about any of the topics we're going to cover tonight, all you have to do is click schedule now, and that will get you to our calendar, and you can schedule a time to visit with us. And so all you have to do is click the schedule now button. The other button that you're going to have available is a question answer button. That's in the upper right hand corner. It says Q&A. And if any time during the workshop you have a question that you would like us to answer, please click on that, and that will give you the opportunity to ask your question. So there's 2 phases in your financial lifetime that you're going to go through. It's the accumulation phase, and that's most likely what you're in right now. When you're putting money into your 401k plans, you're funding your IRAs, 401ks, all of those investments and vehicles that you're going to engage at some point in time after you turn your Social Security on, and some of those kinds of things. And then at some point in time, you're going to start thinking about retirement. And then you enter what we call the distribution phase. That's when we're focused on income and lower risk types of investments. We're trying to preserve capital and make sure that it's going to be there for the rest of your life. Additionally, from a tax perspective, we go through those 2 phases, because during the accumulation phase, we have all kinds of things to lower our taxes. We have child tax credits when our children were growing up, mortgage interest deductions. We had employer paid medical insurance. So we didn't have to come up with a lot of money for those kinds of things. And we had retirement plan contributions that would lower our income. Some of the new challenges that you'll face once you turn your keys in and you decide it's time to retire, you will have a new set of taxes. We're going to have taxes on Social Security. We're going to show you some examples of how you might be able to lower the taxes on your Social Security that you'll be paying, because it's based on your earnings. You have required minimum distributions to think about. We'll be going into detail about required minimum distributions. What those are is at age 72 now, you're forced to take money out of your IRAs and 401ks, those pre-tax vehicles that you've been using. You're going to have to start paying for Medicare. and long-term care. So there's a lot of things to think about as you're entering into retirement. And we're going to see if we can make your mind easier on some of these things as we're going through. Here's our disclaimer. We're not affiliated or endorsed by the Social Security Administration or the IRS. Who's going to be doing your presentation tonight? The name of our company is Unified Legacy Advisors. We're a family-owned and operated business. I'm honored and blessed to be in business with my two sons, Blake and Seth. I'm the old guy in the middle, and Seth is on the left and Blake is on the right. They'll be doing part of the workshop tonight. We are a fiduciary firm. We're independent, and we're a full-service retirement planning firm. We have offices in Omaha and in Lincoln. And I always have to throw in a picture of the grandbabies. Those of you who are grandparents understand. The rest of you are probably going to think that's kind of weird. But I'm very proud of we have 3 children. They've blessed us with 4 grandchildren with 1 on the way. So we have Quinn, Tatum, Henry, and Isla. They're the love of my life, and they keep us very busy. So enough about us. Let's talk about tonight's agenda. What are we going to cover? Seth's going to start off with some of the frequently asked questions we get in our office. We typically have about 100 folks that come through our office in a year's time. And I've been doing this for almost 30 years. So we've got a lot of questions that we hear. And so we're going to answer some of those frequently asked questions. Blake is then going to go into some unique planning strategies and go through some of the tax law updates. We've had 2 recent tax law updates that we're going to just highlight and fill you in on. And then don't miss the ending, because I'm going to go over the 3 most common retirement planning mistakes. We've compiled the 3 that we find the most troublesome to people, and I'm going to go over those 3 and give you some ideas on how you might be able to retire with confidence and not worry about retiring. So again, thank you for your participation. We hope you get a lot out of the presentation tonight, and so we're going to have Seth come in and go over frequently asked questions. Thank you.
Hey everyone, thanks again for joining us tonight. As Mike just mentioned, my goal is going to be to shed some light on the basics and rules of taxes. We're going to start off by going through some of the most frequently asked tax questions we get in our office on a daily basis. So let's go ahead and get started. So the first one's a pretty basic one. How do tax brackets work? So here are the married filing jointly brackets for 2020. And the first thing I want to note here is that the U.S. tax system is what they call a progressive tax system. So what does that mean? So a progressive tax imposes a lower tax rate on lower income individuals and a higher tax rate on higher income individuals. So it takes more money from those higher earners. The main point I want to make here is that a lot of people, when they come in to see us, they think that just because they've reached a certain tax bracket, for example, 24%, that they're going to pay 24% taxes on all of their income. And thankfully, that's not how a progressive tax system works. So let's see how it actually works. Let's assume we have a married couple who earns $175,000 a year. Let's see how their tax liability would be computed. So the first $19,750 would be taxed at just 10%. The next $60,499 at 12%. The next $90,799 at 22%, and that last $3,949 at the highest rate of 24%. Note just that small amount that crept up into that 24% bracket, that $3,949 was taxed at that 24%. So if we add all these up in this example, their tax liability would come up to $30,159, but that's how that progressive system works. Here are the single brackets for 2020. They work just the same as the joint brackets, but they just adjust those numbers down to account for an individual. In this next slide, we're going to go over how different account types are taxed in the accumulation phase versus the distribution phase. So let's start off with the qualified accounts. So those are your 401ks, your 403bs, and other employer accounts. So in the accumulation phase, those grow tax deferred. So as you're putting money in and those are growing, you're not taxed as you're going along. Once you hit that distribution phase, when you're starting to take money out of those accounts for either income or required minimum distributions, that's when you're going to start paying the taxes on those in the distribution phase. The traditional IRAs and inherited IRAs work very similar. They're going to grow tax-free in the accumulation phase, and you're not going to pay taxes on those until you hit that distribution phase when you're starting to take money out of those accounts for income or RMDs. Your Roth IRA accounts are going to work a little bit differently. Those are funded with after-tax dollars, so money that you've already paid your taxes on. So those are going to grow tax deferred in the accumulation phase, but here's where they differ. In the distribution phase, when you start to take money out of those, there's tax-free distribution. Since you've already paid the tax on the front end, you don't have to pay tax when you start taking money out of those. And those are very handy accounts to have in your retirement phase of your life. Your non-qualified accounts, those are also funded with after-tax dollars, and the taxability of those accounts varies depending on what type of investments you have within the account. So your individual stocks are going to be taxed a little bit differently than your mutual funds, but in general, you're taxed as you go on the gain only, on the growth in the account only. So the gain in those accounts is what we call a capital gain. And so let's transition and talk about what capital gains are and how are they taxed. So when you sell an asset for more than you paid for it, or what we call the cost basis, the net profit is considered to be a capital gain. Let's use a simple example here. Let's say you spend $5,000 to buy shares of a certain stock, and then you sell your position for $7,000. You'd have a $2,000 capital gain. Now, if you owned that asset for 1 year or less before selling it, you'd have a short-term gain. If you owned it for more than a year, you'd have a long-term capital gain, and they're taxed a little bit differently. So your short-term capital gains are taxed as ordinary income at your marginal tax rate. So those are those tax brackets that we just went over in the previous slides. Now, your long-term capital gains get favorable tax treatment. And what a lot of people don't know is that your taxable income has an impact on what percentage of capital gains tax you're going to pay. So if we look at the single filer column there, if your taxable income is less than $40,000, you're going to pay 0%. In between $40,000 and $441,000, 15%. And anything greater than that $441,551, you're going to pay the maximum rate of 20%. So that's the maximum rate on those long-term capital gains. So as you can see, they do get favorable tax treatment compared to those short-term gains that we'd looked at. So this next piece is kind of a hot topic in retirement planning, and that's required minimum distributions. So what are RMDs and how do they work? So required minimum distributions are mandatory amounts you have to withdraw from your qualified plans and traditional IRAs once you reach that magic age of 72. That age used to be 70 and a half previous to this year, but with the passing of the Secure Act, they've now bumped that age out to 72. But the IRS is extremely serious about this, so serious, in fact, they impose a 50% penalty, the highest penalty they have on the books, if you miss your required minimum distribution. So let's say I need to take a required minimum distribution of $20,000 in a given year. Let's say I forget to do that. What they're going to do, the IRS is going to send me an I love you letter that's going to say, Seth, we're so sorry you forgot to take your RMD this year. Please send us a check for $10,000. That's for the 50% penalty. Then take your $20,000 distribution and pay the taxes on that distribution that you owe. And don't do it again next year. We'll send you another letter. They're very serious about this, and it's stuff they don't teach you in kindergarten. That's where we come in. We help our clients to make sure that they don't miss these really important dates and aren't worried about these huge penalties getting hit in retirement when they're worried about spending more time with the grandkids, traveling, golfing, whatever you may want to do in your retirement years. So how do they calculate the RMDs? What they do is they divide your prior year's ending account balance by your remaining life expectancy. So let's say I have $500,000 in my IRAs on December 31st of the previous year. What they're going to do is they're going to take that $500,000 and divide it by my remaining life expectancy. And here's where they get that life expectancy numbers. So here is the uniform lifetime tables pulled right off of IRS.gov. And I just want to note here that you typically won't need to calculate your RMDs on your own. You'll just want to make sure that you don't miss the timing of those in retirement and aren't getting hit with those big penalties. So these next two topics I'm going to go over are pretty complicated in their own right. We do entire workshops on these two topics, and that's Social Security and Medicare. I'm going to go over kind of the tax components of those two programs with you today. So let's jump into the Social Security piece. So how is your Social Security tax? So when looking at the taxability of your Social Security income, they're going to take into account what's called your provisional income. The calculation's there on your screen. It's half your Social Security benefit, plus the adjusted gross income from your tax return, plus any tax-exempt interest from any municipal bonds you may own. So if we start by looking at the married filing jointly section there at the right hand of your screen, if your provisional income is less than $32,000, 0% of your benefits would be taxable. It's anything in between $32,000 and $44,000, 50% of your benefits would be taxable. Anything greater than that $44,000, 85% of your benefits would be included in your taxable income. Now, what I'm not saying, for example, if your provisional income is greater than $44,000, that you're going to pay 85% tax rate on those benefits. This just means that 85% of your benefits would be included in your taxable income, and you pay taxes at your ordinary income tax brackets. The individual filing structure is basically the same. They're just adjusting those numbers down to account for an individual. I do want to make a note here that if you're married and filing separately, 85% of your benefits are going to be taxable no matter what your provisional income is. I just wanted to make that note in case that applies to your situation. This is just a snapshot from one of our reports through our software system that we use, and I wanted to share this specific report with you, and that's our current cash flow taxation report. What it does is it shows your income and then the taxes that you're going to pay on that income. So on your Social Security, your ordinary income, your capital gains, and your total taxes. And this shows us a year-by-year look at that. But what I want to focus on is on the right-hand side of your screen, highlighted in red there. That's your Social Security subject to taxes. So what this tells us is what percentage of your Social Security is going to be subject to taxes on a year-by-year basis. And as you can see, this individual in this example, 85% of their Social Security is going to be subject to taxes during the bulk of their retirement years. So what are some of the ways that we might be able to help this individual or help you reduce the taxes that you're going to pay on those Social Security benefits? One of the things we can do is reduce other income with tax advantage investments, but not municipal bonds, because remember, tax exempt interest is included in that provisional income calculation. We can anticipate IRS mandated distributions from your qualified retirement accounts, which may put you in a higher tax bracket. Those are those RMDs that we just talked about. We can delay Social Security, which would reduce the number of years those benefits would be subject to the tax. We can reduce expenses by paying off debt before retirement, and then just continuing to help you manage those taxes throughout your retirement. So those are just some of the ways that we help our clients. It could potentially help you reduce the taxes that you're going to pay on those Social Security benefits. This is the last topic I'm going to cover today, and that's how does my income affect my Medicare premiums? A lot of people don't know that your income actually has an impact on what you're going to pay for your Medicare Part B and Part D premiums. Part B is your hospital coverage, and Part D is your prescription drug coverage. So we put this chart together just to show how much your premiums will increase based on the amount of income you earn. So let's take a look at an example here. Let's say we have a married couple who earns $174,000. In this example, they would pay just the standard Part B cost of $1,735.20 and just their plan cost only for their prescription drug coverage. Let's say they earned $1 more. Let's say they earned $174,001 in a given year. As you can see from the chart there, their Part B premium would jump to $24.28, and it would add $146 to their prescription drug coverage plan. So as you can see, it can have a pretty big impact. You'll see in red there at the bottom of the screen that premiums for 2020 are based on 2018 income levels. Here's how they do this. So they look back 2 years at your income to determine what your premium's going to be for this year. So it can be pretty complicated when you're planning for this on your own. We had a guy that came in after one of our workshops. His name was Tim. He came in recently, and he had told us that his advisor advised him to move off of his group plan through his wife's work and move on to Medicare, and it would be way more cost effective for him to move on to Medicare. And he said, now I'm stuck paying these really high premiums. And why is that? Way more than what I would have paid if I would just stuck on that group plan. And we told him that his advisor didn't take into account his income when projecting his Medicare costs. And that had a major impact on his early retirement years. And he was obviously pretty upset about that. It's really important to work with a holistic planner, someone who's an expert in not only Medicare, but Social Security, taxes, income planning, along with your wealth management and investment planning, to make sure you have a secure retirement and make sure you have the income you need to last the rest of your life. So that is all I have for you guys today. I'm going to hand it off to Blake. He's going to go over some unique planning strategies and some important tax law updates. I really appreciate your time. Look forward to speaking with some of you after the workshop. Thank you.
All right, good evening, everybody. My name is Blake Neben, and I'm one of the retirement planning specialists here at Unified Legacy Advisors. As Seth just mentioned, my goal is going to be to shed some light on some of those unique planning strategies. I'm also going to talk with you about some of the new tax law updates with the Secure Act. I'm sure some of you have heard about that, and also the CARE Act with the recent pandemic that we've all been going through. I'm then going to show you our sophisticated software system that we use to not only answer questions about taxes in retirement, but how to maximize Social Security. What does my income picture look like in retirement? Am I going to be okay? That's what we're trying to help folks out with. So let's go ahead and get started here. Many of you understand the importance of diversification between different types of funds in your retirement accounts. Stocks, bonds, mutual funds, exchange traded funds, cash accounts, which that's all very well important. But what they don't understand sometimes is the importance of diversification between different account types. And what I mean by that is having a balance between IRAs, Roth IRAs, and non-qualified accounts. When you have this balance, it helps you manage your tax brackets in retirement more effectively. What this also does, it allows you to use those tax deferred products where appropriate. It allows you to properly blend withdrawals from your retirement accounts at different times. It allows you to consider which assets should be held in which account type. You must plan how and when you will use taxable, tax-deferred, and tax-free assets to manage your income and tax brackets efficiently. You can't be haphazard on tapping your tax-deferred savings. Timing is everything. And if you don't have a plan in place throughout all stages of retirement, you could encounter unintended tax consequences. So let's take a look at a question that I commonly get when I'm doing retirement planning, often from people. Which accounts do I spend first? So a couple that came in to see us after one of our workshops, Sam and Mary, as you can see, they've done a really good job of saving for retirement. In our discovery conversations with them, hearing about their goals and their objectives and concerns, some of their goals were they wanted to travel a lot and they wanted to see their grandchildren, very common themes in retirement. So in addition to their Social Security income that they were going to have coming in, they each had a $450,000 IRA account. They each had a $60,000 Roth IRA account, and they each had a joint bank savings account of $300,000. Through our discovery conversations with them, we also found out in order to supplement their lifestyle of traveling and paying all of their expenses and those types of things, they needed about $8,500 per month from all sources of income. They knew Social Security was going to pay for a good portion of their income in retirement, but they didn't have it all covered. So they asked, which accounts do we spend from first in order to have an efficient income and reduce our taxes on the income that we're going to be taking from our assets. So what I want to do is show you how we answered that question utilizing our sophisticated software here. So as you can see here, our software system just popped up on the screen. Before we ever recommend where somebody should invest their money, we always run a financial plan that takes into consideration your expenses, your earnings, your taxes that you're going to pay pre and post retirement, your Social Security maximization. When are you able to retire? Can I retire now, or do I need to work a couple more years to ensure the security of my plan? So in that holistic planning process, all of those questions and concerns that pre-retirees and retirees have, we have covered with this software system. So I'll just show you really quick, how do we answer that question of which assets should I spend first? So whether you're married, single, divorced, or widowed, we plug in your name, date of birth, some very basic information. Do you own or rent a home? What's your mortgage? Do you have a number of years left on that? What are your monthly expenses in retirement? We also have to attach a certain rate of inflation to that. Are you currently still working and earning an income? How long do you plan to work? Do you want to work a post-retirement job? Here's where we bring in the taxes. So we have an effective tax rate both pre and post-retirement based on the amount of income that you're going to need each year coming out of your assets. We'll have to tax those differently. What is your Social Security benefit at your full retirement age? Again, this software helps you maximize in time the most efficient way to turn on Social Security. Do you have any pension plans or other miscellaneous income from a business or land that you have, any of that income coming in? And then here's where the important part is. We have these different buckets of assets that some people have a variety of, right? They have IRAs, Roth IRAs, retirement plans from work, savings and investments. Every time that we pull money out, it's going to be taxed differently. The IRAs and 401k plans, you're taxed at ordinary income. Roth IRAs and savings accounts, those are tax-free. You've already paid the taxes on those. So how do we really make this efficient in retirement, and what's the impact? Let me show you that. So it takes all of that information that we loaded up in that, and it puts it all together and optimizes the best plan for income in retirement. And what I want you to notice up here in the far left-hand corner is you'll see the $743,000 left over to heirs. So after they've pulled the income out that they need in retirement each year, our software right now is projecting that they're going to have about $743,000 left over to pass on to their children. So let's see, they had that question, which do I spend first? Which account do I pull from first? Let's see the impact of that. I want to draw your attention to this order of assets down here. It says savings, investments, IRAs, and 401ks, then Roth IRAs. This setup right here for this client, it's not the same for everybody, says that that's the optimal way to utilize the assets and most tax efficient for their income. So what if I drag, let's play a what if. What if I drag this IRA and 401k up to the top? So it's going to reshuffle the deck. And now instead of $743,000 left over at the end of the game, we've had a huge impact. We've dropped that down to $428,000. So one, that reduces your cash flow in retirement and the amount of income that you can take. And then two, if you do have some of those intentions on passing some money down to somebody else, I know some people do, some people don't. But that's okay. It solves both of those. If we do it a different way, where we take the savings and investments first, then the 401k money, then the Roth IRA money, it helps us with optimizing our retirement plan. We can also move these dials around. I'll show you where it says Sam retires at, Mary retires at, to see, hey, can I retire now, or 3 years or 5 years? How does that affect my plan? Or what if one of us dies earlier or lives longer? How does that affect our plan? Do we have a shortfall anywhere? A lot of different questions we can answer with this. So I just wanted to show you that really quick. So back to the presentation here. So one way to help you reduce taxes in retirement is to utilize a strategy called a Roth IRA conversion. I'm sure a lot of you hear about this because it's a big buzz strategy out there right now due to the tax brackets that we're all in. So what this is a Roth IRA conversion is a very simple process where it allows you to take either IRA money or 401k money in like a pre-tax retirement account and convert that over into a Roth IRA. What this does is any amount that you convert from those IRAs or 401ks, that amount is added to your taxable income for that year, and it's taxed at your current rate. So I'll give you an example. Let's assume Jill here has a $100,000 IRA and she wants to convert it all over in 1 year to the Roth IRA. She'd add that $100,000 to her taxable income and it would be taxed at her rate. So for this reason, before you ever think about doing anything with conversions, you always want to talk to a tax professional, your CPA or whoever does your taxes, because it could have big implications on your situation for your retirement. A lot of people think that doing a Roth conversion is an all or nothing thing, and it couldn't be further from the truth. There's an approach that we use called filling up the bracket. So some of you might find yourself in the middle of one of those tax brackets with room to add additional income without pushing yourself up into that higher bracket. And so, for example, if we have a married couple filing jointly and they're in the 22% tax bracket, they have the ability to stay in that tax bracket. They can earn between $80,000 and $170,000 without going up into the 24% tax bracket. So let's assume that your taxable income for a given year is $100,000. That means that you have $70,000 of leeway there to add to that bracket without going up into the higher bracket. So you might consider, hey, I've got some IRA money. I'm going to add $70,000 into this Roth conversion, and what that's going to do is over time it's going to reduce your taxes and help you manage that better in retirement. For those of you who have a larger IRAs, maybe 500 or 750,000, a great thing to do is do smaller Roth conversions over a longer period of time. So what that does is it reduces the taxes on that converted money and also helps spread the tax bill over a number of years rather than doing the conversion all in 1 year. So if you're over 70 and a half and you have an IRA or an inherited IRA and you contribute to a charity, there's another way of doing it rather than simply writing them a check. And what this strategy is called it's called a qualified charitable distribution, or QCD for short. Let me explain how this QCD works and how powerful it can be for someone's situation. So first, there's some rules to this. One, you must be over the age of 70 and a half, have an IRA or an inherited IRA. You can contribute each year up to $100,000 per person to the charity. So if you're a husband and wife, each of you could do $100,000, totaling $200,000. The difference here is that the money must go directly from your IRA or inherited IRA directly to the charity. You can't pay it out to you first, then send it to the charity. A great part about this is it satisfies your required minimum distributions that you're going to have to take. But one of the odd things with this strategy is that you don't get any tax deduction for donating to the charity using this strategy. So why would I have you use a strategy where you don't get any tax deduction? Well, the major part to this is that any money that you send over to that charity out of your IRA is not included in your taxable income. So what this strategy does is it completely cuts out the IRS from ever getting any taxes on that money. The nonprofit doesn't have to pay taxes. You as the person donating don't have to pay taxes, and it satisfies that required minimum distribution. So 3 really great reasons on why you would do this. So we had a client, her name's Joan. She had a $500,000 IRA account. What she was doing was she was taking $10,000 out of her IRA, and she was paying the taxes on that, then sending it over to the United Way. And instead of doing that, we said, well, hey, we have a way that you can give them more money and pay less taxes. So we said, take that $10,000, send it right over there, and it totally cut the IRS out of the equation. So a great strategy to use. Many of you have heard about the Secure Act that's come into place here of 2019. It was signed into law on December 19th, 2019. It went into effect on January 1st, 2020, and it will have a significant impact on retirement savings, legacy planning, and your required minimum distributions. The acronym for the Secure Act means setting every community up for retirement enhancement. And what I did is I wanted to pull 3 bullet points from this act. There's many more, but that would directly affect those that are in or nearing retirement. And they are, they delayed the start of the required minimum distributions. They moved those from 70.5 to 72. They repealed the age limitations for IRA contributions. So for those of you that are over the age of 70.5 and still working, you're allowed to still contribute to your IRA accounts. Before this act was in place, you couldn't do that. This is a big one and kind of a negative one for the beneficiaries of your estate. So they've eliminated stretch IRAs. So what they used to allow you to do is when you passed away and you were going to give that money to your children or whoever was going to be the beneficiary of your estate, they would allow that person or those people to stretch that money out, the distributions from those accounts over your life expectancy. What the IRS has said now is, hey, we want our money sooner. And so they have a mandatory 10-year rule that your beneficiaries have to pull that amount, pull your account values out within a 10-year period of time, which in turn is going to increase their tax bill rather than having the ability to stretch it out over many, many years. The last topic that I'm going to go over tonight before I pass it back over to Mike is the CARES Act. Many of you are aware of the pandemic that we're all going through. So the government stepped in and said, hey, what things can we do to help people out here? So what they've done is they've waived required minimum distributions for 2020. So if you're required to take those distributions, you don't have to do that this year. They've delayed the 2019 tax filing from April 15th to July 15th, as many of you probably already know that, but a great thing for those of you who weren't ready to pay or file. And then for your contributions to your IRAs and Roth IRAs, they've extended those out to July 15th. So for the 2019 contributions, you can still make those for last year's taxes. Hey, I really appreciate everybody tuning in with us tonight. I hope you got some value out of the information that I provided. Just know that we're here as a resource for everybody on this call, and take advantage of that 15-minute conversation. We'd be happy to help everybody out. I'm going to go ahead and pass it back over here to Mike, and he's going to wrap up. But before I do that, I'm going to give everybody a chance to sign up for that 15-minute call here. And thank you.
Okay, everyone, I hope you got some good information in the tax section there. And what we're going to do is I'm going to take the last few minutes that we have here, and as I mentioned, I'm going to go over the 3 most common retirement planning mistakes. As I mentioned, we have over 100 people that come into our office every year, and we see the mistakes happen year in and year out, and people are making the same mistakes. We're just gonna pull the top 3 that we have here in my last few minutes. The first one is not having a written retirement income game plan. So statistics tell us that less than 6% of folks have a game plan for retirement, one that you can pull out and say, here's what's the rest of my life is going to unfold based on what I know today. We've given you some examples of what we put together, but we urge everyone, regardless of whether you work with us or someone else, have a game plan, because what it will do, the number one question that most people have is, am I going to be okay? Am I going to have am I going to have enough money to retire on? Everyone knows how much money they have, but they sometimes don't know how long that's going to last. This answers the question for you. And some folks go online and they do the online calculator thing, and what we find is there's a lot of holes, a lot of missing things when folks do that. In fact, we had a couple in last week that wanted a second opinion. They went online and did one of the online calculators, and there were two gaping holes that they had missed. The online calculator, number one, did not have, they had a bunch of IRAs and 401ks. They didn't have that taxable. They didn't have it in the right columns. The other thing is they left out the premiums that they were going to have to pay for their health care. So those are a couple of things. So make sure you have a written plan. Here's just a screenshot from the plan. You see the total taxes and expenses, the income coming in from the different sources. The second thing is not planning for a long-term care event. I'm just going to read to you from the Lincoln Journal-Star. It says long-term care costs are surging again, and the most expensive option, a private nursing home room, may soon top $100,000 per year. That's something that is a good idea to plan for. So we make sure and stress test the plans to make sure if something like that happens. If you're a couple, a husband and wife, you have an 85% chance of having a long-term care event. So make sure you're planning for that, folks. The last thing is on the risk side of things. So most people that come into our office have no idea how much risk they have in their portfolios. What we have an X-ray that we get from Morningstar that will figure that out in just seconds. And so we encourage folks to make sure they know how much risk they're carrying in their portfolio. And things like what recently happened with the markets having a significant tumble earlier on this year give us the idea of what the impact that have. Not understanding sequence of returns risk. So sequence of returns risk, all that is does it matter when returns happen? The order of that. And we're going to put that to the test here. And what we're going to do is we're going to test it before retirement in the accumulation phase first. So what we're going to do is we're going to show a portfolio, two different portfolios. One, we're putting in $100,000 in the portfolio, the tan section, and we'll put $100,000 in the portfolio, the blue section, portfolio B. And what I want you to notice is the returns. So the returns in portfolio A, -12, -21, -14. What I want you to notice is if we look at the end of portfolio B and read up, so all I've done is I've inverted that table to see, does it matter when those returns happen? And what I want you to notice in this is that in portfolio A, we have totally different numbers all the way down till we get to the very end. And it doesn't matter how we order those. They come up to 684,000. So we took a 40-year-old, we cooked 100,000 for 25 years. So during the accumulation phase of your lifetime, it matters not how we order those. It'll come out to be the same number. But let's take a look at the distribution phase of your life. So in the distribution phase, what we're going to be doing is taking money out of the buckets. And what we're going to do is we're going to take 5% per year annual withdrawals to supplement our retirement income. And we use the same exact returns. So now our person is 65 years old, and we're going to start withdrawing 5% per year. And we're going to see, now does it matter during the distribution phase? And I want you to notice when we look at the tan section there, that once this person is 82 years old, they've run out of money. If they have the bad returns first, they have trouble recovering from that. The people in the blue section, they have $3.1 million at the point that, and then the negative returns at the end are barely a blip on the screen. It's really important to understand how this impacts your portfolio. In the earlier years of retirement, the key is just don't lose the money. Don't have significant losses early on in retirement, and your retirement will flow very smoothly. So lastly, I just want to encourage you to take a holistic approach when you're looking at your retirement. You need to take into consideration a lot of different things. And some planners are holistic planners. Our clientele, all we have in our book of business is those that are in or nearing retirement. We have a very niche practice. And so we would love to help anybody on the call. And in fact, a lot of people will ask, well, how much are you going to charge me for a retirement plan? And for everyone on the call, we will put together a retirement plan for complimentary. With what's going on in our world today, that's one of our give backs, is we'll put together a complimentary plan for anybody on the call. Everyone on the call deserves to have a retirement game plan. So we want to thank you for your attendance tonight. We're going to pop up the offer to have a 15-minute call with our team. If you want to snoop around on us, you can go to unifiedlegacyadvisors.com, and that'll give you some information on us. Again, we thank you, and we look forward to seeing you at some of our other workshops. I know we didn't get to some of the questions, and so what we'll do is we'll take care of those. We're running over time, so we'll take care of those during our calls when we reach out to you. All you have to do is schedule now and click on, and that will reserve your time. Thank you again. Stay safe. We appreciate your attendance.